You're watching Russell Market Week in Review for the week ending March 27th, 2015. We're coming to you today from Russell's world headquarters here in Seattle, Washington. I'm Mark Soupiset. I'm joined again this week by Erik Ristuben, our Chief Investment Strategist. Erik, good morning.
Morning, Mark.
Welcome back. Start here in the U.S. where we saw kind of a final word on the fourth quarter GDP from 2014, 2.2% growth. Yep. Exactly what we were expecting?
Yeah, well, there was no change from what we heard last month. One minor change, which I think was interesting, was that the kind of at the lower, more granular level, consumer spending was up 4.4%, not the 4.2% previously reported. That's kind of in line with expectations. Look, you know, Americans, the consumers, have a lot more money in their pocket because they're not paying as much at the gas pump.
So, as we say here in the U.S. and look specifically now at the markets, we've seen some increased volatility, and I don't mean in the sense that maybe the VIX is necessarily high, but that we've seen sort of on and off in terms of what the market has done. This week was somewhat of an off week, obviously.
Yep, it was an off week.
What's driving that?
Yeah, the Russell 3000 was off about 2% this week. You know, I think there's a couple factors. I think the market is really trying to process the impact of a strong dollar on the U.S. economy and on corporate earnings, right? And it's a headwind. We've talked a lot about that. The other thing that's in the background, right, is that the Fed, right? The Fed is moving away from guidance as a policy tool. You know, when you're in crisis, as they were, you know, a number of years ago, it's really important for everybody to understand exactly what the Fed intends to do. Right. And really what the Fed is trying to do is to get basically as many people on the optimist side of the equation as they possibly can. But as they move forward and you're no longer in crisis, the Fed wants to actually muddy their communications so that actually there isn't, all the risk isn't on one side of the trade or the other side of the trade, and that's what they're doing, right? You know, getting rid of patient, talking about data, you know, a data-dependent decision, and then having all the presidents of the Fed go out there and talk. They're saying a lot, but none of it's specific, and not all of it is entirely consistent with each other. I think they are intentionally muddying the waters so that they can move away from guidance and actually create a little bit more volatility and more balanced risk. Volatility means the risks are balancing out in the system. It's not always a bad thing. Okay,
and you mentioned data-driven. Just one last thing on that. Is the Fed going to make a purely data-driven decision here as far as when they end the quantitative easing or taper it? Or
no decision we make in this world is purely data-driven.
Well,
I think it'll be principally data-driven. And the data they're looking at, as we've said, we think it's going to be wage costs, right? So if wage pressure starts moving up, that's a form of inflation the Fed is going to respond seriously to, and that's the piece of data that we think they're going to look at. Okay. Well, for my last question, I want your data answer and your Erik's gut answer, and that is, let's look at Europe. Their markets were down this week as well, as was Japan. I mean, I think around the world we were off, what, about 2%? Kind of right around the world, yep.
But yet, I think we saw some pretty good economic data out of the European economy. So what was driving those markets downward? Yeah,
the flash PMIs, the composite PMIs that came out this week were better. And data is getting better in Europe. I mean, the economic data. Now, they're on the flip side of it, right? They got a weak euro, and they've got a very stimulative monetary policy. So we're kind of expecting this data to come through. We're getting the data. I think the softness in Europe, the stock 600, as you said, was down a couple percent. I think that softness was really their market, the European market's pretty much gone up in almost a straight line since, you know, Draghi announced quantitative easing. So, you know, markets typically take a pause, and then when you look at our data, getting marginally weaker home sales, you know, existing home sales were not great. I think that was probably more or less the reason. And other than anything sinister, not something sinister, we think the European market has more to go. And the dollar actually took a break this week, which I think is probably good for the system as a whole.
Absolutely. Erik, as always, appreciate your insights. Thanks so much for being with us today, and thank you for being with us on Russell Market Week in Review. We'll see you next week.